Hey everybody, this is Brant from Wolf on Wall Street Trade. I've got a great video for you today. We are going to follow up on last weekend's video, which was basically a call that small caps were going to outperform in June, but there's so much more in that video, so much more that's much more important, which is my forecast, macro forecast moving forward for the market, what to expect going forward from here in the second half of the year. If you haven't seen it, please go check it out. And we'll also talk about the new financial media's narrative, which is the S&P is in a new bull market. I call bull. And I'm going to tell you why and show you why. So let's get started. So first, S&P 500, we had this really dull lateral range. I said S&P 500 needs to close, not trade above 4,200, but close above 4,200, which we got right here. And I talked about that last weekend and why it mattered. The basic gists of it, 4,200, that's going to be a key technical level or key psychological level. In addition to that, you have funds that are chasing performance. So when the S&P was actually in a bear market over here, a lot of these funds did not participate in what has been a rally that's going on 8 months. So above 4,200, they're feeling the pain, and what they need to do is chase performance because they have to outperform the benchmark index. If they're charging 2 and 20% management fees, they need to outperform the S&P, the benchmark index, and many of them have not been doing that. So that is fund performance chasing. FOMO, fear of missing out. You have this kind of rally, and people have been in this for 8 months saying, oh, I don't believe it, it's a bear market. And they have missed out on these gains. And then, of course, you have the shorts that have not believed this rally, and they are at more and more pain every time the market moves higher. So above 4,200, you start to see short covering. That is part of why I expected small caps, which have been the worst performer of 2023, to outperform in June. Here we are looking at a 60-minute chart of the S&P 500. You can see that right up here. And this is 1, 2, 3, 4, 5, 6, 7, almost 8 weeks of trending in this lateral range, right? And only about 35 points or less from here to 4,200, right? That's less than 1% away from 4,200. Could not make that. As soon as we got the close above 4,200, what happens? Over the next week, the S&P gains 2.2% or another 100 points. So it couldn't gain 35 points to get to 4,200 in 8 weeks, but as soon as we close above that, it takes less than a week to make up the next 100 points and come up to 4,300, which is where we are now. This is the evidence of what I was saying all along, why a close above 4,200 was so important and would change dynamics. Zooming in a little bit closer so we can see the recent action. Here's the breakout. You can see the 4,200 level right there. By Thursday of this week, the S&P did what? It gained 20% off the October market lows, and that has perpetuated this myth in financial media that the S&P 500 is now in a bull market because it is 20.2% off the October lows. That is a very, very arbitrary way to define a bull market. I do not agree with it, but here it is nonetheless. Market insiders, the bear market in stocks has officially ended. New bull market has kicked off. If you are a subscriber to my website or you've been following my videos here on YouTube, then you know that we were looking for a strong rally coming into October. This is the Dow. And that is a little W bottom or W base. And the Dow did what? From the October low until the November high right over here, gained 20%, right? Same exact financial media narrative came up. I did an entire video on it. Here is the actual video from late November. Is the Dow entering a new bull market? My opinion, my view, which was correct at the time, was absolutely not. So what has the Dow done since then? We can take a look at the actual gain from the time the financial media was saying, oh, the Dow's in a new bull market. Dow's actually down 2% as of Friday's close since then. So not only would you have been wrong to chase this whole narrative of a new bull market, you would have lost a little bit of money, and actually you would have missed a lot of opportunity to make money elsewhere. Because what happened next? In January, we got rotation into the NASDAQ 100. So from January, NASDAQ 100, look at the gains. Late December, a lot of tax loss selling. NASDAQ 100 mega cap stocks were just absolutely horrible in 2022 because of rate risk, 36%, while the Dow did nothing from November on and was a laggard in January, didn't even make a gain at the end of May. You missed an opportunity to be long the NASDAQ, which was our call, gained 36% there from the lows in December. Our recent call of last weekend's video, and we were touching on it the week before that for members, that information was coming every day for my subscribers. The call was that small caps would start to outperform in June. But what I'm going to show you is why this is not a new bull market. So 20% off the highs, they call a bear market. 20% off the lows, they call a new bull market. It's very arbitrary. Okay, so if you're in a stock like Tesla, it drops 20% from all-time highs. That is a minor pullback in a bull trend. It is not a new bear market. Now, obviously, the beta on averages are not that high, but the same thing applies. It's just an arbitrary figure. So let's look at the S&P 500 real quick. Of course, here is the 20% off the October lows, 20.2%. But what is more important, and the way you define a bull market or a bear market, is the primary trend. So I'm going to show you a primary downtrend, bear market, which we had most of 2022 until October. A primary downtrend, by my definition, is a series of lower highs, lower lows in the primary trend. Okay, so up until this point, we have a bear market. My call going into October, we got our first hint of this in August, and we're looking for bases into October, was that we would see a market that would trend more laterally for a while. Not a bear market rally like this, but a more lateral trend. You can see that much more clearly in small caps. So here is the primary downtrend or bear market, and then our call was for a intermediate lateral trend. So you have your primary trend, which is your bull bear markets. You have your intermediate trend, which is what we have here, lateral. That was the call. And then you have your sub-intermediate and short-term trends. Now, if we look at an average like NASDAQ 100, it actually looks better, and it should look better after that 30-some-odd% gain. But why it looks better is that it did make a higher high. But this is not a new primary uptrend. This is the first higher high. So it would have to confirm by coming down, testing, and then making a higher low, and then another higher high. Then we're starting to move into a classification of a primary uptrend. We are not there, and we are certainly not there in the S&P 500. As you can see, the S&P 500 has not made a new higher high. So there's absolutely no reason to call this a bull market, except for the fact that you get money, you get dumb money, you get money that has underperformed, that missed this rally, start to chase the market because they're saying, oh my gosh, I missed this whole thing. I've missed 20% gains, and I don't want to miss anymore. We're in a new bull market. CNBC says so. Video update from last weekend is so important because I lay out exactly what I believe is going to happen, what I'm seeing happen, and what that's going to mean going forward. So institutional money, they have huge positions. Huge positions. They're not like you and I that can say, okay, I've been long this, I'm going to get out Friday and sell it and be done with it. If they tried to do that, they would crash the market because of the size of their positions. They have to sell them into price demand under the radar. You won't see it at the index level. Rising prices is good for them. They sell into that demand. It's called distribution. So more often than not, that is why a top, like we saw over here at the end of 2021, is not an event. It is a process. Now, I'm going to transition back to what I expected to be talking about this weekend, which is a follow-up to last weekend's video. Again, if you have not seen that video and you want to have a broad overview of what I think is coming the second half of this year, which starts at the end of this month, that video is absolutely key. Okay, so now picking up with the whole theme from last weekend's video of small caps to outperform in June. If you look at what the NASDAQ did, which we already saw over 30% year to date, and then you look at what small caps did, what you'll see is they did nothing. Okay, this is one of the reasons that I thought small caps would rotate in down year to date while the NASDAQ's up 33%. Are you going to buy an index that's already up 30 odd percent in 5 months, or are you going to look for the bargain that has not moved? That would include the Dow as well at the end of May. We move into June and look what happens. Exactly what we're expecting. Small caps rotate into leadership. They start acting better. But another reason for that is there was huge short exposure in my most shorted index, which is mostly small to mid cap stocks. They were at the lowest they've been since the COVID crash. So there was major ammo for a short squeeze, and pretty much most of this rally that we've seen so far in June in small caps has been all short covering. Small caps are going to outperform instead of NASDAQ. So on the week, the S&P gained 0.4%, the Dow gained just shy of 0.4%, the NASDAQ 100 was down just shy of 0.2%, but small caps were up 1.65%, so they well outperformed anything else out there. Adding my trend lines, you can see where regional banks broke down here and it hit small caps hard. They have a lot of exposure, and the change in character where price got above this short-term level of May resistance and the breakout here, which it had not been able to do since mid-March. And if we look at volume, we can see that we got a breakout on decent volume. So small caps are looking pretty good to start off June. However, for the S&P 500 to make that 20% gain from last year's low, small caps are not going to do anything for that. S&P has no small caps in it. What will do that is the mega caps, and the mega caps are really part of what you see in NASDAQ, why NASDAQ's been outperforming. And the call last weekend was that small caps are going to outperform, NASDAQ is going to underperform, which was the case as of Wednesday. So as of Wednesday of this week, small caps were up almost 3%. The NASDAQ was down, the NASDAQ 100, down 1.65%. The S&P was pretty much flat, down 0.35% on the week to date as of Wednesday. So for the S&P 500 to make that higher close to the new bull market, what had to happen? We had to see a transition from small cap leadership at the beginning of the week, Monday, Tuesday, Wednesday, to the mega caps, which we actually did see. And a shout out to a couple of our subscribers that played this perfectly. They made money in small caps the first half of the week. Then they followed the signals that I put out on Wednesday afternoon, and they made money in the NASDAQ the second half of the week. Here is my Wednesday, June 7th afternoon update. This is posted before the close. And what was I saying here? The headline, tech and mega caps to get some short-term relief. And if you read on here, you'll see what I'm talking about, that they are going to rotate in middle of the week. I'll show you why. This is a chart and excerpt from that very same post on Wednesday afternoon. Apple, arguably the most important stock in the market, with a clear 3C positive divergence. This is my own indicator. It is a proprietary money flow indicator. And as we come into the lows over here, Wednesday afternoon, we start seeing some buying, which was really important for Apple. But it was also a sign that we were going to see that rotation into Thursday away from small caps and into the mega caps, which would help the S&P 500. Here is the next chart in that post. XLK, the tech sector. 3C is confirming to the downside. We come into Wednesday afternoon. What is it doing? Positively diverging. That means that it is being bought into the price decline. That is the power of 3C. It can contradict price and show you where there's accumulation or distribution. And while I'm not going to go through the whole post, I'll show you the next chart, which was IWM small caps, massive positive divergence into the end of May, right here, the end of May. Who's doing this? Well, generally speaking, the people that rotate at the end of the month or the end of the quarter are usually smart money, hedge funds, and the like. You can see them doing that. Huge positive divergence into these lows in IWM small caps. Here's the month of June, and price takes off following 3C, catching up to 3C. But as of Wednesday afternoon, 3C is no longer confirming. This is not a big deal, but this is the kind of signal that we see right before consolidation. This is why I made the call in that Wednesday afternoon update that I think we're going to see some rotation. IWM small caps are going to take a much needed break, consolidate, and we will see the mega caps come in and start to lead the rest of the week, which will help the S&P 500 make that 20% close. Before we go on, I want to show you one other thing, though, that was very important. Apple, which is arguably the most important stock in the market, and everybody who is in the market is watching that. And here's a daily chart of Apple with volume and a 200-day average of volume at the bottom. And I just want to roll up to January because that's where the mega caps started to outperform. They rotated in, right? So there's January. Apple's been doing nothing but heading up. But we did have a very, very ugly day on Tuesday. So first, I'm going to show you the volume right here. The heaviest downside volume, sell-side volume of the year for Apple. And then we're going to zoom in closer and we're going to look at the day right here. And what you have is a very bearish day in kind of like old-time technical analysis vernacular. You'd call this an outside day. In candlestick vernacular, you would call this a bearish engulfing candle of a small doji star, which is a loss of upside momentum and on heavy volume. That's a distribution day. That is not pretty for Apple. And this goes into everything I was talking about last weekend about what we should expect moving forward. Now I'm going to move you to an intraday chart because we get a lot of information on those. So you're looking at a 15-minute chart of Apple, and I've rolled it back to about noontime on Wednesday. Here is the big distribution day that I just showed you. This is a bear flag, okay? It's not a huge one, but it is a bear flag. There is the flagpole. Here is the flag. What would have happened if this bear flag broke down, even though it wouldn't have been a huge move, is this massive, strong uptrend would have been broken from March, and traders would have noticed that. That would have changed the entire tone of the market. So, as of Wednesday afternoon, when I put out that post, Apple was one of the charts I was showing that was seeing accumulation. Because if this had broken down, that would have changed everything. I'm going to just go ahead and roll this chart forward, and what you see is the start of a breakdown, a little back test, and then we already had the accumulation in 3C. It negated that bear flag, okay? Had it not negated that bear flag, this is the trend that would have been broken. Technical traders, hedge funds, everybody would have seen this. It would have changed the entire tone of the market. This was a big stick save. I would not be surprised if smart money, who was actually selling this the day before, actually gave it a little support to keep it from breaking down. The reason why? Because they need to get out of this position and they need to sell a lot of shares. They do not want to do it in the falling prices by adding a lot more demand and working against themselves, causing prices to fall more. So in my view, above and beyond just the mega caps helping the S&P get to that 20% gain off of its all-time lows, or off its bear market lows rather, I think this in itself was a really big part of why we saw that accumulation late in the day on Wednesday. And a lot of our members switched from being long small caps early in the week to mega caps at the end of the week. They got out Friday and made profit on both of them and are resting and enjoying their weekend. I want to give a particular shout out to Kenneth L. Great job. As far as moving the S&P 500, like I said earlier, small caps won't do it. They do not. There's no small cap stocks in the S&P 500 for one. There are mega cap stocks, and the S&P 500 is a cap weighted index. All right, so mega caps have a very strong influence. So coming back to this post Wednesday afternoon about this rotation that I'm seeing in this 3C charts I just showed you, from Wednesday's close to Friday's close, small caps lost 1.2%, NASDAQ gained 1.6%. The S&P 500 benefited from the NASDAQ gain. It gained 0.75% and got that new 20% new bull market nonsense. Now, kind of picking up with last weekend's video and the theme of this transition from phase 1 to phase 2 and distribution, okay, selling into price strength by institutional money. We're going to pick up on that theme real quick. But we know smart money needs to sell into price strength. So a headline like this, new bull market, helpful or not? Yeah, it's helpful. During the week, the venerable Goldman Sachs, that was sarcastic, said that small caps gains in June, right, are a sign that the economy is going to have a soft landing and not go into recession. Okay, now normally I would agree when small caps outperform, that is a sign that the economy is looking better. They're domestically focused, all that stuff. But are you really going to say that after like 9 days of like relative performance, after you've seen NASDAQ go for 5 months of like incredible relative strength? You're going to make that call? That's a bunch of BS coming from Goldman Sachs. And what did they do on Friday, Goldman Sachs? They said, oh, we're going to raise our S&P 500 year-end target from 4,000, which they've been wrong on for a while because we've been well above 4,000, to 4,500. You've got the new bull market headlines. You've got Goldman Sachs saying small caps outperforming in June is a sign that the economy is going to be fine. It's going to have a soft landing. And then you have Goldman Sachs raising their S&P target, which they were wrong about in the first place, from 4,000 to 4,500. You think Goldman Sachs is doing any of that for your benefit? No. They're doing it for their benefit. Remember I said institutional money needs to sell into price strength. Who is institutional money? Goldman Sachs. And we can already see that it is changing sentiments. Not that I would go making any investment decisions based on this, but you can see the fear and greed index is up here now in extreme greed. Okay, so investors are getting more bullish. That is what all of this is about, right? We can see the fear and greed index. October highs right here where the Dow outperformed. Extreme greed, right? Over here, January, where the NASDAQ really performed well into February, you see greed. So this is not a leading indicator. This is a lagging indicator, but it's telling you what the mom and pop investors are doing, and they're just following the market. When you see these sentiment indicators at extremes, like extreme greed or extreme fear, more often than not, they are contrarian signals. Ask yourself, does this improving sentiment help smart money sell into price strength or not? Of course it does. As far as what Goldman said about small caps starting to outperform and that being a sign that the economy is going to have a soft landing, well, I'm going to tell you right now, the whole reason we thought small caps had a chance to rotate in was how much short pressure there was, mostly because of the regional banks, right? What you're looking at now is the S&P 500, and my most shorted index is my own index of a watch list, equal weighted index of the most shorted stocks, and they're generally small mid-cap stocks. You can see kind of trending along over here with the S&P into the end of May. What you can't see, if you really look at this on a broader basis, is that this index was basically at the lowest levels it had been at since the COVID crash when everybody was super bearish. We come into the start of the month, short squeeze. Look at the huge short squeeze. This benefits small caps. Matter of fact, if you change the S&P 500 and you put up IWM, these two track almost perfectly together. So what you're seeing is not, oh, we love energy stocks, we love material stocks, we love the regional banks, we think they're going to do great into this new economy. No, what you're seeing is shorts being squeezed. When a short has to cover a position because they're at a loss, it is called buying to cover, and in the market is no different from buying. They are buying. That causes more upside pressure. Price moves higher, more shorts at a bigger loss, they have to cover. That's how you get this kind of short squeeze. The one question I would ask is, if Goldman Sachs thinks the economy is doing so well, why are institutional investors hedging massive downside risk? So this is the CBOE skew index. This is December of 2021, all-time market highs right before we enter a bear market in 2022. This is April, really high reading again. And what happens from there? S&P loses 20%. This recent real high reading was right before the debt ceiling got resolved. And then it started to come down. But now it's started to go back up again. Debt ceiling is resolved. I really don't think it's about the Fed next week, because even if they hike by 25 basis points, that's irrelevant in 525 basis points. of hikes over the last 14 months. And this is generally a form of hedging or kind of like an insurance policy that you don't see kind of the average retail trader doing. Hedge funds and stuff are doing stuff like this. So that tells you something, that they're worried about something. As far as the near term, I still lean towards small caps and maybe Dow still outperforming in the month of June, at least until further notice. One of the things I had been really hammering over probably about the last month with my subscribers is the rate risk to mega caps. They really got pounded in 2022 because of rising yields. So in addition to taking profits on an index that gained over 30% in 5 months, in addition to the phase 1, phase 2 transition that I talked about in last weekend's video, there was also this rate risk. So what you're looking at here is NASDAQ 100 futures NQ. This is a 4-hour chart. The blue line is the 10-year Treasury future. Remember that Treasury yields move opposite of Treasury prices. There's been an incredibly strong inverse correlation between yields and stocks and yields and gold. So right here we can see on this 4-hour chart that this is yields coming down, and it led the NASDAQ 100 higher. What I have been pointing out recently is this alligator jaw of death in which yields are rising. The NASDAQ had been rising, rate risk, which is like an immediate threat. NASDAQ ignored it for almost a month, and that was because of the whole AI craze. Like AI is the next, .com thing. Everybody wants to own AI stocks. That kind of happened towards the end of the mega caps outperformance this year in like May. But what I think we're starting to see now is pressure on these NASDAQ 100 stocks for all the other reasons, plus this rate risk. If I show you a little closer view, and this is the same two assets, NASDAQ 100, 10-year Treasury futures, you can see over here yields are dropping sharply. That leads NASDAQ higher, and this is where we get those alligator jaws of death, where yields are rising, NASDAQ's been ignoring it. This is a real downside risk. In addition to all that, price tells us a lot, and NASDAQ 100 is really close to having met its measured move. I'm going to show you that real quick. So here's a 4-hour chart, NASDAQ 100. Here's where mega caps rotated in at the start of January. Here is our first measured move, big bull flag, and these are so accurate. Measured move, second leg, the NASDAQ is basically 1.5% away from completing that measured move. In the context of a gain of 36% off this low, I think it's like close enough, but still very, very close to meeting that measured move. And the most probable thing that happens once that measured move is met is that stocks either consolidate or, in this case, I believe probably a reversal. But the measured moves are very accurate, and price will linger around that area for a while, like it kind of has been over here. And taking a little closer look, we've had really, really bullish price action in the NASDAQ 100 and the mega caps and most of the mega cap heavy sectors all throughout 2023. You can see this last bull flag, and it fell just short of the measured move. But what we're seeing over in this area is not a bullish consolidation. It's more of a lateral kind of choppy range, which is typical of a distribution zone. Can we confirm that with some evidence? So far we can. So this is QQQ, the ETF for the NASDAQ 100. This is 3C. Over here in the beginning of May, you can see 3C is leading prices higher. We get a little correction here, leading prices higher. 3C is making higher highs until we get into what? June, right over here. What starts happening? We start seeing 3C negatively diverge here, negatively diverge there. Now remember, distribution is a process, not an event. That doesn't necessarily mean the NASDAQ 100 is going to drop like a rock next week. But this is evidence of the things I talked about in last weekend's video that I've been talking about for quite a while. And this whole phase 1, phase 2, and the timing of phase 2, I have held the view that it's going to be at the end of Q2, moving into the second half of the year for probably 6, 8, 9 months. And here's a 15-minute chart of small caps or IWM, and the reason why I think they are still going to outperform. Here's the breakout that was really important for them on good volume. We have a nice advance here, right? We get a little pullback here, hold support. We get another advance, and so far, over this past week, starting Wednesday. Remember what we talked about happened Wednesday? We have a little consolidation, and so far it looks like either a little bull flag or a bull pennant. That is a consolidation continuation pattern. So the continuation would be of the prior trend, consolidates and then moves up again. If we take a look at IWM's short-term 3C chart in this area, what we see is the same thing I showed you earlier, massive positive divergence, buying into price weakness or this kind of flat area, the consolidation signal, and we are just starting to see 3C start to move above that. So as a bullish consolidation matures, what you'll start to see is buyers coming into it, and 3C will start moving higher. So we'll be looking for that next week, but I don't see any problem with this chart so far in terms of price or 3C. So I think that small caps have more upside to go. But since this is really a short squeeze driven event, I think that it could change much more quickly than what we saw in the NASDAQ, where it went 5 months, and it'll probably take the rest of the month for distribution to really move price lower. In IWM's case, basically, I think once you see those shorts cover, it's going to have a real hard time from a fundamental case owning small caps, owning cyclical stocks, heading into what I believe, and again, it's in last weekend's video, why heading into a recession that we'll start to see materializing the second half of this year. One other thing of interest I want to talk about real quick with IWM's measured move coming out of this base. It is, I actually have it drawn using a log chart, using a fairly generous interpretation. This is about the measured move off of what we might consider a base. It's a really weak formed base, but if we add that onto here and then we look at our current consolidation, I'm going to zoom in a little bit closer on that and just draw in a real quick rough estimate of the measured move on that. And then all we do is add that to the breakout point. And I believe that we'll see this consolidate probably a couple more days, because we do have the CPI report on Tuesday, and then we also have the Fed on Wednesday. But let's just say as of Monday afternoon, we saw this bull flag continue to consolidate. You would add it to the breakout point there, and look, it would pretty much fulfill that measured move. Actually, I think this will probably consolidate a little bit longer, so it may come in right at that. Right now, that's around the 192.65 area for IWM, but if this flag continues to develop for a few more days, then the measured move percent will be the same, but it will start from a lower level from wherever it breaks out. But this is all telling us the same thing, that we're probably targeting this area. The S&P closing above 4,300, it traded above 4,300 on Friday, but it did not close above 4,300, and just like we saw with 4,200, the close is really important. So just below that. But what I think might happen is the same thing that we saw with IWM or small caps. There is a lot of short presence in S&P futures. Let me show you that real quick. This is the COT data for S&P E-mini futures, the non-commercials, or the specs, so it's generally the hedge funds. They are at the shortest that they have been in a long time. And just this week, we saw just a teeny bit of short covering. So if S&P closes above 4,300, I think we could see some more short covering that drives S&P higher. That gives institutional money, again, the opportunity to sell into price strength. But basically, my view is that we are transitioning into phase 2, which is where the market will start to turn. Okay, the market's really bullish right now. We can see that in sentiment. Has not been, but it is getting there. It's getting really bullish. But I think we will start to see that turn, and that's what I've expected in June. Actually, by the end of Q2, which is the end of June, and we do have some evidence of that. We can see that starting to happen in NASDAQ as we entered right into June, right there, June 1st. Okay. Before that, 3C was spectacular. It was confirming to the upside. We have the same thing in the S&P 500, the SPY. Over here, you can see 3C leading price higher, confirming as we come into June 1st. What are we seeing? Exactly what I thought we were going to see months ago at the end of Q2 or into the end of Q2. We're starting to see distribution. We're starting to see selling pressure. So the more prices rise, the easier it is for these big funds to put out more shares and to sell them without knocking price down, without working against themselves. That is the process of distribution. That is the beauty of my proprietary indicator 3C, which is tracking accumulation and distribution. As I said before, it has the power to contradict price. So what you see at the index level for the common Joe or the common trader may look very good, but what you see behind the scenes under the hood looks completely different. You've got retail money, or what some people call dumb money. I'm not saying that, but retail money. Listen to CNBC, listening to Goldman Sachs saying we're in a new bull market. Small caps are outperforming. That means the economy's going to do better. They're going to buy this crap. Okay, that works to institutional money's advantage. And ultimately, what I think will happen is that you're going to be setting up this epic rug pull where the market maybe even goes parabolic to the end here, toward the end of the month I'm talking about, and you see there's really bullish price action, but under the hood we see distribution, and that will leave mom and pop investors holding the bag. That is what I think is coming. Again, I keep saying last weekend's video, you have to participate in your own success. Next week's going to be really busy. We have the CPI report, last inflation report on Tuesday before the Fed or the FOMC decision on Wednesday. I do not think that they hike. We have China stats Wednesday. China's economy is not looking good, already looking recessionary. We have the European Central Bank on Thursday with their rate decision, and the Bank of Japan on Friday. So it's going to be a busy week. Everybody have a fantastic weekend. Members, I will see you on Monday. And if you're not a member, you should really consider subscribing, because just look at what happened in the middle of this week. That call of small caps rotating out and mega caps rotating in, the NASDAQ 100, had a lot of our subscribers making money on small caps at the first half of the week, and then the mega caps into the weekend, and then just enjoying their weekend with profits.